Welcome again to Ask a CFO. We're here as ever today with James Vanreusel, founder of Vanreusel Ventures. Morning, James.
Morning.
Morning. How are you today?
Doing great.
Excited to be here, ready for to go back under the spotlight.
Yeah. I love these little mini videos.
Always helpful, and I've had some great feedback so far. So let me ask you then today's question: what's the role of a finance department in identifying and evaluating new business opportunities?
I think you always look at the finance department as the numbers. So assuming that the numbers are correct, and assuming we're looking at identifying whether we're talking about a product, maybe a new product feature, a new product launch, something like that is what we're looking at, then I think the numbers are really pointing towards some kind of a return on investment, right? So how much is it going to cost me to do this launch, to take this opportunity? And I think the numbers are multifold. So it's not just how many dollars are we going to spend just on, could be marketing, could be sales. How many new sales people do we need to hire to cover this? It also involves just everybody's time, because when you think of new products, the head of product is really looking at how can we launch the product on time. He's kind of a project manager, but it's the entire team that is giving input as to what the project should be. So if you're evaluating whether to launch something, you're really looking at time spent with customers, time spent with the whole executive team, deciding on whether it's a good idea, and then finance has to come in and say, right, this is how much it's going to cost, this is how many new people are going to come in, and you would look at the head of sales and say, right, how much of this do you think you can sell based on current conversations with customers, but also with past requests from customers. And so it's definitely, it's not an exact science, but it's something where I think you do have to come up with some kind of an Excel spreadsheet that calculates this return on investment.
And what sort of nuances, what variables do you need to build into your model there, apart from, say, the promises that you get from the salesperson, and you say you're head of sales, you can say, okay, that's your number, we're holding you to account if you don't hit that. But what other sort of variables should be in there?
Yeah, I like using milestones or stage gates, and it refers a little bit to like having an MVP, a minimum viable product, that okay, let's build something and let's see if it's actually selling, and let's see if it's actually true. So the whole let's say the whole investment's $1 million. You could probably do that initial investment up to 100,000 and then say, right, are we, what are the metrics here? Are we getting any traction? Are we not? And then if there is, then let's go to the next stage, and maybe the next milestone is 3 months out for another launch of some sort, and you'll spend another 250,000, and then you reevaluate so that you can actually pull the plug if it's not working. And I think those milestones are set by the head of product in the project management timeline. But that's how I like to do it. That's how I like to manage the risk, because in most things, you're always managing risk. There's always a certain risk-reward trade-off, and you want to make sure that the reward is multiples of the potential risk of a loss.
And how useful is something like a market trend analysis, seeing how comparable products have fared in the past, when there are so many different sort of variables there around sort of time and competition and so on? Is that even useful?
Yeah, I think every input is useful. I think you do want to do the market research, and I think that there are several inputs. I think there's always this gut feel of the market is there. I think you always kind of know it, but I think at the same time, you do want to have some kind of market research report coming in with numbers actually saying, yes, this was here because if it's a big enough product launch, it's something that'll come up at the board meeting, and you'll have to justify to the board members, this is why we're doing it. This is the data inputs that tells us that there is demand, and also you need to figure out how you're going to price it. And so some of that's going to come from the existing products, market research, competitors, etc.
Okay, so the question that we've got here really is twofold. Of course, identifying and evaluating. We've talked a bit about evaluating there. So in terms of spotting the opportunity in the first place, I mean, is that something that a finance department would get involved in? Sort of looking between the lines in a spreadsheet and saying, well, we've got a customer base here that would be paying this much more, or is not getting a need served. Is that something that would happen?
I always find that the numbers never lie, and the numbers tell the story. So if you can segment your sales enough into different customer segments, different sizes, here are top 25 sales or ACV customers, and this is the longevity of how long they've been with us, and this is what they're buying, and this is how much the prices are going up of these specific products. I think you can easily say these are our most profitable segments. These are our most profitable customers. This is where we really want to focus. So if somebody comes along with an opportunity that's not in those areas, you can say, I don't know if we want to focus there. Or you can make the case to the CEO, this is really where the opportunity is. But I think finance typically drives its analyses and its decisions and answers based off of the numbers.
Fantastic. So what I'm hearing really is get as much data as you possibly can, factor it in any way that you can, and then just be extremely cautious, just releasing the capital bit by bit, and push the button, really go ahead as soon as you have some kind of indication to say, yes, this is a legitimate opportunity.
Yeah, and you'll never have 100% of the information. It's always going to be, whatever you feel comfortable with as a CEO, what your risk profile is. But it could be 60%, it could be 70 or 80% of the data before your gut check steps in and says, let's do this.
And where does your relationship with your investors fit into that? Because they've given you the money and you're pursuing a new sort of going potentially in a new direction or trialing a new product. Is this something where you want to be sort of keeping your investors very firmly in the loop? Yeah,
I think typically for investor-based startups or scale-ups, you'd have monthly updates to the investors, but the investors aren't driving the managerial responsibilities and decision making. You would really just tell them this is where we're going. And I think the governance of the company can step in with the fact that, you're going to have quarterly board meetings anyway. You're going to discuss it with the board if there is an issue, and you'll probably end up with investors on the board as well. Mm-hmm. They can give their feedback as to, what they think you should do. And I think unless it's catastrophic, I don't think they're really going to step in and start managing the company themselves. Like that is just not their mission. That's not what they want to do.
Yeah, interviewed a few investors recently, and I think they were all of one mind where that's concerned. That the last thing they want to be doing really is any kind of interventions.
Yeah.
Fantastic. That's great. Thank you very much, James, and we'll be back next time. If you have a question for James, please let us know. Just drop it into the comments below or tweet hashtag #AskACFO. We'll pick it up. We will put it to James, and we will see you then. Okay, thanks. Bye now.